Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Okay, thanks everyone for joining our webinar. Today's title is Managing Your FX Options, Straddles and Strangles, and we're lucky enough to have Jason Ayres from optionsource.net on today. And just to tell you a little bit about Jason, Jason's been an independent trader and investor for over 10 years. He's president and founder of optionsource.net, and he's been providing education and opportunities in the stock and options markets for over the last 5 years. In addition to overseeing the day-to-day operations at optionsource.net, he actively advocates and promotes the utilization of options for managing risk, cash flow, and leverage, and this includes the development of numerous strategic relationships with some of the most prominent brokerages and exchanges in North America. His expertise extends to standard equity currency options and commodity options, and optionsource.net is one of Canada's leading educators in trading stocks, options, futures, forex, and commodities. And with that, we should have Jason on if we're not having any technical difficulties. Just to let everyone know, if you have any questions, feel free to use the chat or the Q&A functions over on the right, and we'll be answering them throughout the webinar. Some of them we'll be answering at the end. So Jason, are you on the line? Doesn't sound like he's on yet. Okay.
Oh, there we go. Yeah,
there
I guess I had control there. Hey, John, how you doing today?
Good. How's it going, Jason? Nice to talk to you again.
Fantastic. Thanks. You too. Yeah. Yeah. Thanks very much for the opportunity. I see a lot of familiar faces online as well, so it's always makes things a little more comfortable for me, of course, when you recognize a few names. We're going to obviously talk tonight about managing our FX options, straddles and strangles. Talk a little bit about establishing long straddles and strangles to take advantage of a directional bias, and also how we can use a short strangle to generate some cash flow. So whenever you want me to go ahead, you just let me know, John. Oh, and evidently he wants me to go ahead. So thanks very much, everybody, once again for joining me here this evening. I think John did a pretty solid job at introducing me, and many folks online here already know where I'm from and what I do. So without any further ado, let's move forward and talk a little bit about utilizing the FX options and creating some interesting strategies surrounding some of our trading observations. First of all, I just want to reinforce the importance of this disclaimer, the fact that we're going to talk about some relevant market observations and establishing some strategies that are relevant to the market right now. But we're doing this for, of course, educational purposes, and really, as you can see, based on this disclaimer, it's not a recommendation to buy or sell any of these securities, and make sure that you educate yourself before you start clicking any buttons, basically. When we talk, first of all, about this market that we're looking to establish these strategies on, really just want to give a little bit of an overview of the FX options and the different products that are available at the ISC. As you can see here, there's a very sort of robust list of the different currency pairs that you can trade your views on. We have the U.S. Versus the Euro, U.S. versus Canadian, U.S. versus Japanese Yen, which are, of course, some of the more popular ones, the U.S. versus the Great British Pound. But as you can see, the ISC is adding more products on a month-to-month basis, and really a lot of folks are interested in trading their directional views in the currencies markets. It's, of course, one of the is the largest market traded around the world, but some people are a little afraid of doing it in the actual spot market. So these options, these FX options, actually make for a great alternative for you to trade your directional bias. Now they're accessible through many of your standard options brokers, which means that if you are already options eligible with the broker that you are trading with, you can quite likely access any of these pair values to take advantage of any opportunities that you might see. They are cash settled in U.S. dollars, so there's in fact no underlying shares that are traded. The charts that you would be looking at, based on the symbols that you can see essentially down the middle of the chart here, are essentially what are referred to as notional indices, and so no shares traded, which means the options are cash settled, and they're European-style exercise simply because there are no shares to exchange hands and no real rationale for early exercise. You can, of course, buy and sell them at any time within the life cycle of the option contract, so you can use that to, of course, lock in profits or cut your losses at any given time. One thing that I just want to highlight real quickly is the www.fxoptions.com. The ISE has done a fantastic job at putting together a website that is focused specifically on the FX options that they have that are traded on the exchange. Some great education, great information. We're going to look a little bit more closely at one of the tools that they have available on the site. But if you're interested in learning any more about this particular market, certainly visit fxoptions.com and you'll see what I mean. It's a pretty slick-looking site. They've done a great job with it. Now, without any further ado, let's really start getting into the whole rationale behind why we would look to create a straddle or a strangle surrounding a particular pair value. First of all, what we have to understand is that a straddle or a strangle from a trading objective, or from the reason why we would look to trade a straddle or strangle or create that strategy is based on essentially our outlook on the underlying pair value. In order to really determine when would be an appropriate time to use these strategies, we have to understand that these strategies are based on the volatility of the underlying security, as well as the volatility of the actual option contracts that are traded based on the move in the underlying security. When we talk about understanding volatility, there's really two types of volatility that we look at. The first is historical volatility, which is essentially a measurement of how a particular security, in this case the pair value, whether it's the CDD, the US Canadian, or the EUI, the US Euro, we're really looking at what the underlying security has been doing over a specific period of time. It in fact measures the deviation from its average price. What we would be looking for from a historical volatility perspective when we're considering putting together a straddle or a strangle is whether or not that particular security has the ability to make a significant move either in one direction or another. So we have to understand that volatility is not so much directionally specific, but whether or not the pair value can move significantly in one direction or the other. Now, the other type of volatility that we would be referencing is implied volatility. Now, implied volatility is based on the market expectation of a future value in that particular security, and option contracts will be priced based on that anticipated value. So if, for example, a particular pair value has not been making a lot of movement over a certain period of time, well, the historical volatility would be relatively low, and the implied volatility, because of that, would also be relatively low, and as a result, option contracts would be considered to be priced in line or relatively inexpensive. Now, what happens in an environment where volatility is expanding is that there is an anticipation that is being built into a movement in that particular underlying security. And what happens is, as that volatility expands, the price of the option premiums will begin to factor that in. And because a market maker has to take the opposite side of every transaction, they will begin to increase the value of the option contract in order to compensate for the risk that they're taking on.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.